You know that feeling when you hear economists on the news and it's like they're speaking a completely different language? Well, today we're going to crack the code. We're diving into macroeconomics, but don't worry, we're leaving the jargon at the door. This is all about the big picture of how our economy actually works.
So let's start with the question. Think about it for a second. What do jobs, the price of your groceries, and all that stuff we buy from other countries, what do they all have in common? Well, the answer is they're all pieces of this giant tangled-up puzzle we call the economy.
And trying to understand that whole puzzle, that is macroeconomics. It's really all about perspective. Imagine you're flying in an airplane. Microeconomics is like looking down and seeing one specific house, one specific business. But macroeconomics, that's when you're at 30,000 feet, seeing the entire city, the whole landscape. We're talking about the whole forest, not just the individual trees.
Okay, so here's how we're going to tackle this. First, we'll get that big picture view. Then, we'll look at the economy's natural ups and downs. After that, we'll talk about the policy levers used to steer things, the great debate over how to use them, and finally, we'll bring it all home and see how it affects you personally. Ready? Let's jump in.
All right, let's start with the 30,000-foot view. To really get a handle on an economy's health, you got to know how to check its pulse. And these large-scale indicators, they're basically the economy's vital signs.
So when economists want to check up, they look at a few key scorecards. You've definitely heard of these. First up is GDP, or Gross Domestic Product. That's basically the price tag for everything a country makes and sells in a year. Then you've got the inflation rate. This one's a big deal. It tells you how quickly the cash in your wallet is losing its power to buy stuff. And of course, there's the unemployment rate. Together, these three numbers give us a really powerful snapshot of how things are going, and policymakers are constantly trying to juggle them to get the balance just right.
Next up, let's talk about the economy's rhythm, its heartbeat, if you will. Because here's the thing, economies never ever move in a perfectly straight line. They breathe, they expand, and they contract. And this pattern, while not perfectly predictable down to the day, is a totally natural cycle.
And that pattern has a name, the economic cycle. It's just this natural ebb and flow, and understanding this rhythm is huge. It helps businesses, investors, and honestly, even you and me get a sense of when things are looking up and when it might be smart to be a little more cautious.
This cycle usually breaks down into 4 stages. First, you have the expansion. These are the good times, right? The economy is growing, jobs are easier to find, things are looking up. Then it hits a peak. That's the high point, where growth can't really go any faster. After the peak comes the contraction. Things start to slow down. And if that slowdown is bad enough and lasts long enough, that's what we call a recession. Finally, the economy hits bottom, a trough, before it picks itself back up and the whole cycle starts over again.
So, how long does this whole roller coaster ride usually last? Well, if you look at the U.S. economy since the 1950s, the average cycle, from the bottom of one dip to the bottom of the next, is about 5.5 years. But, and this is a really big but, that's just an average. They're not all the same. Some are super short, and others can be incredibly long. I mean, just look at the expansion we had after the 2008 crisis. That one lasted for more than 10 years.
So, if we know these cycles are going to happen, is there anything we can do about it? Can we maybe make the good times last longer and the bad times, well, less bad? The answer is yes, or at least we try. And that brings us to the policy levers. Think of it as the economy's toolkit.
Inside this toolkit, you've basically got 2 main sets of tools. On one side, you have monetary policy. This is the job of the nation's central bank. In the U.S., that's the Federal Reserve, or the Fed. Their main tools are tinkering with interest rates and the overall supply of money. On the other side, you have fiscal policy. This is what the government, Congress, and the president controls. Their tools are government spending and taxes. You can think of them as the gas and the brakes for the economy.
Okay, so we have the tools. But just because you have a wrench doesn't mean you know how to fix a car, right? And that leads us to one of the biggest, oldest debates in all of economics. It's like we've got 2 completely different instruction manuals for how to drive this thing.
And here it is, the main event, Keynesian versus classical economics. The Keynesian school of thought says that when the economy is in trouble, the government absolutely has to step in. They need to spend money to get things moving again, to create demand. The classical view? Totally different. They're all about laissez-faire, which is just a fancy way of saying hands-off. They believe that free markets are amazing things that will eventually fix themselves, and that when the government tries to meddle, it usually just messes things up.
Now, the classical camp has this really clever and kind of controversial argument against that whole government spending idea. It's a theory called Ricardian equivalence, and if it's true, well, it suggests that a big chunk of government stimulus might not even work.
So here's the logic behind it. Let's say the government decides to give everyone a tax cut. Great, right? But to do that, they have to borrow money. The theory says that smart, rational people will look at this and think, okay, a tax cut today just means higher taxes tomorrow to pay back all this debt. So what do you do with that extra cash? You don't spend it, you save it for that future tax bill. And if everyone does that, poof, the stimulus has zero effect.
Of course, that's the theory. In the real world, are we all perfectly rational calculators? Probably not. Let's be honest. When you get a check in the mail, do you immediately think about tax rates 10 years from now? The evidence is pretty clear that people tend to spend at least some of a tax cut, especially when they really need the money. And that spending definitely gives the economy a little jolt.
All right, we've been talking big picture stuff. Theories, policies, cycles. Now let's bring it all down to earth. Let's connect the dots from all this global economic stuff right to your wallet.
A really important idea here is something called the balance of trade. And it sounds complicated, but it's not. It's just the difference between what a country sells to the world, its exports, and what it buys from the world, its imports. If you sell more than you buy, that's a trade surplus. If you buy more than you sell, which the US does a lot, that's a trade deficit.
So, who cares about a trade deficit? Well, you should, because it has a direct impact on the value of your money. Let me walk you through it. Let's say the US is buying a ton of stuff from South Africa. To buy those South African goods, American companies have to trade their US dollars for South African rand. What happens then? It's just simple supply and demand. You've got a flood of dollars hitting the market and a ton of demand for rand. The result? The dollar gets a little weaker and the rand gets a little stronger.
And that's the final piece of the puzzle that hits your pocketbook. When the dollar is weaker, all the stuff we import, your phone, your coffee, your car, it all gets more expensive. But there's always a flip side. A weaker dollar also means that American-made goods are now cheaper for people in other countries to buy. So it can actually help US companies sell more overseas. It's this constant global balancing act.
So that brings us to the end. We've looked at how to check the economy's vital signs. We understand its engine and its natural cycles. We've seen the toolkit policymakers have. We've even read the 2 competing instruction manuals. You'd think with all that, we'd have this whole thing figured out by now. So I want to leave you with this question to chew on. Why is it that after all this time and all this brain power, trying to drive the economy is still one of the hardest things in the world to get right?